Hi guys, so welcome back to the second part of the recording of your 2022 exam paper work through. On our collab on Monday night, I went through question 1 to question 3, and now I'm going to do from question 3 to, I think it goes to question 6 at the end of the paper. So I will upload this question paper to your Learn, either probably in more resources for you. That's if I can get a version without the memo attached, because we're not allowed to upload memos, but let me see what I can do. Otherwise, you'll just have to work with this version with the questions that you can see on the screen here. Okay, so I'm going to share my screen so that I can bring up the questions for you. Okay, so shortly you should be able to see the screen. Okay, you should see our kaleidoscope, and now let me go to the papers. Okay, so here's our question 4. That was as far as we got on Monday evening. So this question is for 45 marks. And you provided with the following balances at the end of September. Always make note of your dates for the amount, or for the trial balances or the amounts that they have provided for you. It's very important that you double check to see, are these amounts as at the beginning of the year, or are they at the end of the year? So this is for the end of the financial year, as they've said, end of September. So basically what's happened is that this is then a pre-adjustment trial balance. Okay, where they are giving us balances, but we still have to go and make some adjustments to those balances. So additional information, and then here a profit for the year was calculated. This is before any of the adjustments below. Okay, that's important. So the profit currently, as it stands, with these figures here, our profit is 25,670. Then we still have to take into account these adjustments below. We've done a physical stock count that revealed that the stock on hand was valued at 44,000 Rand. So we always compare the physical stock count value to our theoretical stock count value, which will be our trading inventory. We currently are showing a value of 47,000 Rand for trading inventory. That's our theoretical value as we came to the end of the financial year. Then we went and we actually did a physical stock count, and we only had 44,000 Rand. So there is a difference there. Sorry. What was it? 47 and 44. So there's a difference of 3,000 Rand. So we've actually got 3,000 Rand less inventory than we are currently reporting. So we have to adjust this 47,000 down to equal 44, because our final closing financial statements must always reflect what the true situation is. Then also 1,000 Rands worth of stock had been stolen. So we have to also reflect the fact that 1,000 Rand of stock is missing or stolen. And then the owner had also taken trading inventory worth 2,000 Rand on the last day of the year for his own use. So we also have to reduce our inventory by this 2,000 Rand for the fact that the owner has taken it. Okay, so that's basically then our 3,000 Rand difference. 1,000 Rand was stolen and the owner took 2,000 Rand. So we still have to reflect the stolen stock and the 2,000 that the owner took. So neither the stolen stock nor the owner's stock withdrawal had been recorded. So that accounts for why we were reflecting 47,000 Rand on our TB, but we actually only counted 44,000 on hand. Then capital includes a 10,000 Rand contribution that was made by the owner during the year. So remember again, if we go to capital here, this is capital as at the end of the financial year, which is 50,000. They said that during the financial year, the owner contributed 10. So that means we would have started the year with 40,000 and then added 10,000 during the year, giving us our 50,000 Rand closing balance. Credit losses of 2,000 Rand must still be written off. So what happens with credit losses? Credit losses is money owed to us by our customers. So in other words, we would currently be reflecting that amount in our debtors control or trade debtors. But 2,000 Rand of that is not going to be paid to us. So if we go up here to our debtors control, we've got 10,500. We've got to reduce that by 2,000 because not all of that is going to be paid to us. So we have to make that adjustment. Then 3,000 Rand was received from a debtor who was previously written off as irrecoverable. So when we originally previously wrote that 3,000 Rand off, we would have debited, oops, sorry, wrong one, where was I? Here. When we originally wrote that 3,000, we would have debited credit losses and we would have credited debtors control. That's what happened when it was written off. Now that debtor has paid us. So we have to reflect, we now have to reflect the fact that they have paid us. So what are we going to, what's going to happen now? We have to put the 3,000 Rand into our bank account. So we've got to debit bank. And what are we going to credit? We can't credit debtors control because debtors control was already credited when we originally wrote that 3,000 Rand off. So now we credit an income account called bad debts recovered. And that's an income account. Remember, income is also reflected as a credit balance. Then with the next adjustment, an amount of 550 Rand is owed for electricity for the month of September. The invoice has been received but not yet paid. So this is going to be an expense accrual. Because we've now received the invoice, but we haven't processed that invoice yet. So we haven't yet reflected the fact that we have got an expense of 550 Rand for electricity. So we're not showing the expense accounts here. These are all just the balance sheet accounts. Okay, so that will basically affect this profit figure over here. We have to reduce the profit by that amount of 550 because we have to reflect another expense for that electricity. And then 10,000 Rand of the loan from XXX Bank will be paid off during the next financial year. So why are they telling us that? Because whenever it comes to long-term loans, where's our loan? Here we've got a long-term loan. We need to know how much of this loan is non-current and how much of the loan is going to be current. So remember, anything that's going to be current means it will be paid off within the next 12 months, and anything that's non-current means we will only pay those parts of the loans off beyond the next 12 months. So the first part of the question for 8 marks, complete the statement of changes in equity for the year ending 30th of September 2022. Okay, so to do a question like this, you have to have memorized the format for your statement of changes in equity. so that you know exactly how it is headed and what are the different line items that are included in a statement of changes in equity. Write down your format or your template for the statement of changes in equity, and then go and do the workings for each of the line items. So let's go and have a look at what that would look like. Here we go. Statement of changes in equity. So we know that for that, we have to start out with the balance as at the beginning of the year in our equity. So equity for our business is going to be the capital account of the owner. So as I showed you in the workings already, our trial balance is showing that at the end of the year, we have got a closing balance of 50,000, but the additional information told us that during the year, the owner contributed 10,000. So that means we started the year out with 40,000. So you must show balances at the 1st of October 2021 is then 40,000. Because the format of a statement of changes in equity requires us to reflect any additional contributions as a separate line item. We must show it separately so that the readers can see exactly how much additional contribution was made during the year. So we will then reflect that 10,000 Rand that we've taken off there. We reflect it separately in a line over here. So now we've got opening balance of capital of 40 plus the 10,000 Rand that the owner contributed during the year, giving a closing balance of the capital account of 50,000. So then what else affects our total equity in a year? We take opening balance plus additional contributions, then we add to that the profit for the current year. And we would deduct it if it was a loss. And then we also then have to reflect minus any drawings that the owner took during this current year. So how we now need to go and calculate the profit for the year. So remember, they initially gave us this value here of 25,670, which was, they said before the adjustments, our profit was 25,670. Then we've made a reduction in profit of 1,000 Rand. So what was that? Can you remember? That is the 1,000 Rands worth of inventory that was stolen. We've also reduced the profit by 2,000 Rand and by 550 Rand, and we've increased it by 3,000 Rand. So this 3,000 Rand increase was that other income that we got, which was the bad debts recovered. This 3,000 Rand is the bad debts recovered. Minus the 1,000 was the inventory that was stolen. So let's just go and have a look at what the other minus 2,000 was and the other minus 550. So there was our starting out profit. There's the 1,000 Rand that we have to write off because it was stock that had been stolen. The trading inventory worth 2,000 Rand is not a loss to the business. What is our journal entry going to be for that 2,000 Rand that the owner took? We're going to debit drawings and we're going to credit inventory. Okay, so that does not affect profit. It affects drawings and inventory. Capital, we've taken that into account. Here's our 2,000 Rand. Credit losses of 2,000 Rand must still be written off because we are going to credit debtors control or trade debtors, and we will debit the expense account credit losses. So that is our 2,000 Rand that we had to deduct from the profit over there. And the 550, I think that was the accrual for electricity. Yeah, and here we go. And the accrual for the electricity, that 550, our journal entry there would have been to debit the expense account electricity and to credit the liability account accruals or expense accruals. So we've got then our adjusted profit of 25,120 that we are add in to our capital. And then we have to subtract from that the drawings. So the opening drawings on the TB was 5,000, and we are increasing the amount of the drawings that the owner took during the year by that 2,000 Rand inventory that we still had to make the adjustment for. So if you look over here, the initial drawings given to us was 5,000. And then it said here, the owner had also taken inventory worth 2,000. So we had to do another debit to drawings of that extra 2,000. So then we've got all the workings that we need to calculate our closing balance for equity. So it's opening capital plus contribution during the year plus the adjusted profit figure for the current financial year minus the total drawings that the owner took for the year equals closing value of owner's equity at the end of the year. Okay. That's a lot of work for 8 marks, because remember also 8 marks means that you have only got 8 minutes to complete that. So that is a very good illustration of the fact that you really need to know exactly what these line items in your statement of changes in equity are, so that you can quickly write them down. Opening balance plus contributions plus profit minus drawings equals closing balance. And then go and have a look at the question to fill in as much of the workings that you can identify to come to a closing. And remember, guys, this is why it's important to show all of your workings, because you can see the marks are allocated to the workings. So even if you've left some of the workings out and you didn't get all of the amounts, you will get marks for whatever you've been able to identify and include. And if you take a note here as well, there is a half a mark for each line item for identifying correctly that you had to say balance plus contribution plus profit minus drawings equals balance. There were marks for those the line items as well. So it's very, very important, the format in which you write your answers down always. Okay, and then just let's have a look at trade and other receivables. I just quickly want to go back and make sure that this recording is working. Okay, make sure the microphone is still there. So then 4.2 for 7 marks, complete the trade and other receivables, and this should say trade and other receivables note. I can't see that if I do it like that. The trade and other receivables note for the year ending 30th of September. So we want trade and other receivables. They also want the trade and other payables note, and they want the cash and cash equivalents note. So 3 of the notes that they want us to complete. So remember your trade and other receivables. These will all be debit balances, because these are amounts that are owing to you, which are assets. Trade and other payables, these will all be accounts with credit balances, because these will be liabilities that you owe to other people. So this just helps you to identify what belongs under trade and other receivables. You're looking for accounts with debit balances, which represent amounts that somebody owes you, and other trade and other payables, you are looking for accounts with credit balances that represent amounts that you owe other people. Cash and cash equivalent, we'll get to that when we do it. So the trade and other receivables, we'll go there again. You'll always start out with trade receivables is your debtors control account. So the 10,500 here, that is a receivable. Accrued income counts as a receivable because this is a debit balance. Because when we, this is a, where was I? This is a debit balance because when we record accrued income, we debit accrued income and credit income. What type of balance is prepaid expenses? This is going to be a credit balance, because when we record a prepaid, debit, yeah, that's right, because when we record a prepaid expense, we go to an expense account that we've already recorded and we credit the expense account. Sorry, no, I did get that right. We credit the expense account to reduce the expense, and we debit the prepaid expense account to show that we've paid that account early. So technically speaking, that person at this moment in time owes us that money. And only once the new month starts do we then owe them the money. Just as a note, what happens with accrued income and prepaid expenses, in the month of September, you will record the expense or the income as accrued income, and you'll record the expense as a prepaid expense. And then when you get to the 1st of October, you then reverse those journal entries where you would credit prepaid expenses and debit the expense account. And you would debit the income account and credit the accrued income account. So these are also temporary balances that we just use these accounts to adjust the actual income and the actual expense amounts in our income statement as for a specific period. What else have we got here? Oh, here's accrued expenses. Accrued expenses is a debit balance. I'm muddling you up. That's a credit balance because we debit the expense account and credit the accrued expense account. And income received in advance is a, what is that? Income received in advance, we have credited income, we're going to debit income, and we're going to credit income received in advance. Hopefully I've got that the right way around. Accrued income, I've credited income and debited accrued income. Income received in advance, yes, I think that's the right way around. Okay, so then let's go and have a look at the notes. Trade and other receivables, there's the opening balance according to the trial balance. And we have reduced that by the 2,000 Rand. And that 2,000 Rand was this credit losses of 2,000 Rand that must be written off. Okay, we had to debit credit loss expense and credit debtors control. So that was that. And then we're recording the other two debit balances. Remember, these are debit balances. Payables will be your credit balances. And our other two debit balances are accrued income, because we credited the income account and debited accrued income, and the prepaid expense because we credited the expense account and debited prepaid expense. So that's our trade and other receivables note. And then your trade and other payables note, we then go to trade creditors. What's the money that we owe to other people? Creditors control. So take note, in the trial balance, this is called creditors control and this is called debtors control. But when it comes to the actual note itself, we use the formal language of trade debtors and trade creditors, because the note is called trade and other receivables and trade and other payables. So trade creditors straight from the TB, and then accrued expenses. So the 3.5 comes from the TB here, the 3.5. And the 550 is the electricity that we had to still record as an extra accrual. And then income received in advance is the other 2,000 from the TB over here. Okay, where we debited income and credited income received in advance. Income received in advance is if somebody has paid us, or we recognized income that we should only recognize in the following period. You've got all of these four, what we call accrual accounts here. Accrued expenses, income received in advance, accrued income, and prepaid expenses. That is all in that one section in your textbooks under that section of accruals. our 4 different types of accruals that we can get. And then cash and cash equivalents, we are going to record all of the banking accounts or bank or cash, anything that is bank or what we call cash equivalent, which means it is, what's the word, liquid. Liquid means that it is actual cash, or it is as close to cash as it can get, so that we regard it as cash. So our bank, 56,000, that comes from our TB, and it said their bank favorable, so we know that that is a debit balance, and they've put debit in brackets as well. Just pay attention to that, because sometimes the bank might be unfavorable, which means it's an overdraft, in which case that would be a credit balance. So just to make sure that you add those amounts incorrectly. And then we've got petty cash of 4,500, and we've got cash float of 2,000. So these here are our cash and cash equivalents. But then one of our adjustments said that 3,000 Rand was received from a debtor. And for that amount over there, we debited the bank account. So that's why we add in that extra 3,000 Rand into the bank account over there. That's the extra 3,000 Rand that we received from a previous bad debt that had been written off. So these 8 marks for statement of changes in equity might have been a little bit tough, but then you've got 7 marks for trade and other receivables, 8 marks for trade and other payables, and 6 for cash and cash equivalents. So you can definitely make up any time lost over here in these 3 notes here, without a doubt. You must watch the time. If it says 7 marks, you've got to have a look to see what time did you start working on that question, and make sure you only take 7 minutes or less. You have to force yourself. You've got to track your time as you go through the question. And then the last part of the question was they wanted the statement of financial position. So statement of financial position is basically then our balance sheet, which is all of our assets, our liabilities, and our capital accounts. Okay, those are the accounts that belong in the statement of financial position. Remember also this, you have to have memorized the format: statement of financial position, statement of changes in equity, statement of comprehensive income. You must memorize those so that you can quickly get the correct format. Just practice them over and over again with blank paper, just writing the line items down that you need until you know you've remembered them correctly. You've got 16 minutes to do this question. Okay, and for this one over here, they said complete the equity and liability section only in the statement of financial position. So not the entire thing, just equity and liability section. So remember, the heading for this section is equity and liabilities, and then we first start out with owner's equity, and then underneath that we've got equity and liabilities. Then we do owner's equity first, then we do non-current liabilities, and then underneath that we do current liabilities. So those 3 items is what makes up equity and liabilities. So our owner's equity, this 68,120, must come from your statement of changes in equity that you already did in 4.1. Because this statement of changes in equity is where you worked out what the closing balance of equity is that would appear in your statement of financial position. So in order to get this mark, this figure here has to agree to your question 4.1. Then the heading non-current liabilities. So these are liabilities that you are going to owe, or that are only going to be due longer than the next 12 months. So remember, our bank loan is 35,000, but it said that 10,000 Rand of the loan is going to be paid in the next 12 months. So the long-term portion of the loan is then only 25,000. And take note at these marks given for work-ins. You must show your work-ins. It was the only non-current liability that we had. And then under current liabilities, we've got trade and other payables, which this amount here must agree to your trade and other payables note. Because remember, these notes are our work-ins for these amounts that will then appear in our statement of financial position. So in order to get the mark for trade and other payables, that figure has to agree to your answer for 4.3. So these notes are our work-ins. We do these notes in order to work out these balances, and then these balances are the amounts that we then see in our statement of financial position. And then over here, that 10,000 Rand that we took out of the loan, we must show it here under short-term portion of the loan. So under non-current liabilities, we've got long-term portion of the loan, and under current liabilities, we've got the short-term portion of the loan. So that 25 and that 10, that's our 35,000 of the total loan that we owe, split between long-term and short-term portion. Okay. So that's a really good question for 45 marks. Very important. Again, in your textbooks, you've got lots of questions and examples of pre-adjustment, trial balances, adjustments, and then drawing up the financial statements with the notes at the end of after doing the adjustments. So please make sure that you have practiced that. Okay, so that's question 4. Then let's go and have a look at our question 5. So this one is only for 25 marks. So this will then mean that you want to take 25 minutes. Keep reminding yourself of that. It's very important. And this is a partnership question. A and G partnership have the following balances at year end. And in this case, our year end is the 31st of August. So at the end of the year, partner G, his capital account has got a balance of 35,000. Partner G's current account has got a 25,000. It says a credit balance. So remember, capital, oh dear, sorry, where did I go? Capital account is a credit balance because it's the equity side. Remember your accounting equation, assets on the left-hand side is a debit equals owner's equity plus liabilities on the right-hand side are credits. So capital is an owner's equity account, and they say that the owner's current account is a credit balance because remember the current account can be a credit balance if the business owes the partner money, and it will be a debit balance if the partner owes the business money. And in this case, it is a credit. And then drawings, so that's a credit. And drawings is the owner's expense account, and that's always going to be a debit. Remember our dead click, our accounts that have a carrying debit balance are expenses, assets, and drawings, and our accounts that have a carrying credit balance are liabilities, income, and capital. So we've got 2 capital accounts and 1 drawings account. And then this tells us that the partners earn 6% interest on their capital balances. They are charged 8% interest on their drawings balances, and they will earn 10% interest on their current account balances. And that's obviously as long as their current account balances are in credit, they'll earn interest. And then each partner, and we've got two partners, partner A and partner G, they earn a salary of 4,000 Rand per month. So this is the important bit of information to take note of there. Make sure you don't read so quickly that you miss that. And then partner G, so this is this guy here, also earns a bonus of 30,000 per year. So that is only once off for the year, whereas the salary they each get for every month of the year. Then at the end of the year, the partnership had a profit for the year of 415,800. So take note that that is the entire partnership as a whole. Their profit is 415,800. So that is the profit that must be shared between the partners. And the partnership agreement says that profits and losses are shared in the ratio 4:3. So partner A, it's 4 parts. Partner G, it's 3 parts. So we've got 7 parts in total. Partner A's 4 parts and partner G's 3 parts. There are 7 parts in total. So the profit must be divided into 7. And of those 7, A will get 4 parts. So A will get 4/7 and G will get 3/7. Okay. So for 4.5 marks, calculate the interest on capital account, on the current account and the drawings account for partner G only. So they've given you here the 3 interest, 6% on capital, 8% on interest, and 10% on current account balances. So you just had to go and do those calculations. So remember partner G only. So make sure you are doing the correct thing. Always show your description so that you don't just write down just these amounts on your paper. Head your work-ins, label your work-ins so that it's very clear exactly what you've done. And all you do is you go and look up their capital account balance multiplied by 6%, their current account balance multiplied by 10%, and their drawings balance multiplied by 8%. So these amounts came from the list that they gave you, and the percentages were in the additional information. Then question 5.2 said calculate the remaining profit that can be distributed to the partners after taking all partnership transactions into account. So when we get to the end of the financial year, we have got our total profit that we've calculated for the year. Out of that profit, these interests and salaries and bonuses must be paid to each of the partners according to the partnership agreement. And then the amount of profit that is left over will be split in this 4:3 ratio. So they want to know how much of the 415,800 will be left over after paying the interest and salaries and bonuses that we need to take into it. And here they give us the information for partner A. They've just given us the calculated amounts of the interest and the drawings. We didn't have to go and multiply out the amounts by the percentages. They've given you the actual amount of interest, etc. So 5.2, 415,800, that's the total profit. Again, I would have preferred to see them labeling this correctly so that you can follow the workings. So the 3.6 is the interest on capital on partner A, and the 2.1 is the interest on partner G. The 1.5 is interest on current account of partner A, and the 2.5 is interest on current account on partner G. The 1.2 is interest on drawings on partner A, and the 760 interest on drawings for partner G. So take note that the profit is reduced by the interest that we, the business, owes to the partners, and the profit is increased by the amount of interest on drawings that the partners owe to the business. Okay, so minus that and plus those two amounts. And then this minus 30,000 is partner G's bonus. And the minus 4,500 salary per month times 12 months times 2 partners, that's the salaries for both partners. So that leaves us with 270,060 as the remaining profit after the partners have been paid all of their agreed amounts. And then question 5.3 asks us to then calculate the amount of the remaining profit share that must be given to partner A and to partner G. So we've got the amount that you calculated in 5.2. You'll get this half method mark as long as you've taken your answer to 5.2 and multiplied it by 4/7 for partner A and multiplied it by 3/7 for partner G, and indicated clearly that that's A and that's G. Okay. And then for 5.4, they said calculate partner A's current account balance as at the 31st of August after taking all the relevant transactions above into account. So remember, partner A, they gave us this information over here for partner A. And they said you can assume that the current account balance of partner A as at the 31st of August 2022 was 15,000 credit before any of the adjustments above. So in other words, his opening current account balance was 15,000, and then we needed to make all the adjustments. So we take okay, this is an error. That shouldn't say G, because this is for partner A, but that's just the description on the memo. So his opening balance of 15,000, and then plus his 2 lots of interest on his current and his capital account, minus his interest on his drawings that he owes to the business, plus his salary. And remember, partner A didn't get any bonus. That was all he got. And then plus his share of the remaining profit must get added. And then this is then his final current account total after everything has been calculated. Take note again at these number of marks, because that will indicate how long you have got to complete those questions. Okay, so that's your 25 marks for question 5. And then for question 6, the last one, it's only a 10-mark question. Oh, I see we've got question 7. I thought we only had 6 questions. Answer the questions relating to a closed corporation, a CC below. Write the answer next to the question number in your answer book. So all of these are basically 10 marks of theory questions. What is the maximum number of owners that a CC can have? That answer is 10. This is all in your textbooks. What type of business would you register instead of a CC? Because remember, CCs don't, not that they don't exist anymore, they do exist, but we can no longer register new CCs. So CCs no longer exist. So what would we have to register instead of a CC? What's the most, the similar type of business? So that would be a company or a private company, a PTY Limited. And 6.3, what does it mean if we say the owners of a CC have limited liability? So basically a definition or an explanation of limited liability. And that just means that they're not held liable or accountable for the debts of the company. So as soon as you've registered a PTY Limited, the PTY Limited stands as its own legal entity, separate from the partners, from the owner's legal entity. And the debts and assets of the business and the owners are separate. So 2 marks as long as you've given 2 points, and then for 6 marks, all corporations including CCs, share 3 distinct characteristics. What are they? And briefly explain each characteristic. So 6 marks, 3 marks for naming the characteristics, and then 1 mark for an explanation of each of those characteristics. So all corporations in common have got 3 distinct characteristics that we need to identify for that specific corporation. So that is the corporation's legal existence, the corporation's limited liability, and perpetual succession. So take note that they said all corporations, which means a corporation is a business that has been registered, so a CC or a PTY limited. They're not talking here about sole traders. So all registered companies have got a separate legal existence from the owners. They've got limited liability. The owners don't have to pay the debts of the business. And they we create perpetual succession by creating a CC, which means that the CC or the PTY limited continues in its own name, even if the owners themselves pass away. Remember, always just explain things in your own words. You don't have to memorize out of the textbook. So as long as you've understood it, when you're learning these things, make sure you understand them, and then you'll always be able to come up with a sentence in your own words to explain something. And then the last mark, also just a quick theory question for 5 marks. Complete the table below by writing down only the question number and next to it the correct answer in your answer book. So here on the left-hand side, we've got the formal bookkeeping system and descriptions that fit with that. And on the right-hand side, we've got the indigenous bookkeeping system. And you could also call it the informal businesses. So an informal business is always, the bookkeeping system is tailored to the needs of the owner. But in a formal bookkeeping system, the bookkeeping records is governed by IFRS, or IFRS as we call it. 7.2, in a formal bookkeeping system, it must be supported by source documents, whereas in an informal system, most of the transactions are just cash transactions, and there's often no source documents that are retained. In an informal bookkeeping system, transactions are done using hard cash. There's often no bank account that even exists for that business. Whereas for a formal bookkeeping system, all cash transactions must be done through a current bank account. So as soon as you register a PTY limited, you have to go to the bank with your registration documents and register a bank account in the name of that PTY limited. Because remember, as soon as there's a separate PTY limited, it needs to have its own bank account separate from the owners of that business, and then all transactions go through that bank account. 7.4, a formal bookkeeping system has extensive control measures in place to manage resources effectively, whereas an informal system, there's usually only one owner and there's no control measures excepting for self-management, or we could also call that self-control or self-discipline of that owner. And then 7.5, an informal company plans business on a day-to-day basis. They basically live from hand to mouth, whereas a formal business does planning and draws up budgets at least once a year, and they do forward planning for at least a year, sometimes 5 years into the future. Okay, so that is the end of question 7. So that's a full run through of a full exam paper. Showing you again, I've tried to just highlight how you should approach the questions, how you should record your workings, the format your answers must be in, the number of marks per question indicates the number of minutes that you've got for that question. And those are the things that you just must not forget when you're sitting there writing. These are all things they're talking about self-management, and these are things that you need to self-manage while you are writing your paper. Okay, guys, so I'm going to end the recording now so that it doesn't go on any longer. Let me just get back here. Where was I? And I will post this for you as soon as possible. Okay, thanks, guys. I hope this is helpful. And then I will see you next time in your exam NSS, where we'll do another exam paper, and that will be on the 14th of June, so 1 week from today. Okay, thanks, guys. See ya.